Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we're going to talk about the economy, the stock market, as well as gold and silver. So it looks like last week almost 46 million Americans filed for unemployment claims since the lockdown began. So this brings at least the 13th week total to 45.7 million, dramatically more than any period in American history. And although continuing claims dropped, it's hardly a signal that the reopening is going to occur and have any long impact. More than twice as many Americans have filed for unemployment than jobs gained during the last decade since the end of the Great Recession. That's 22 million gained in a decade and 45 million lost in 13 weeks. There's a wave of defaults arriving, with weekly bankruptcy filings suddenly soaring the most in 11 years. So according to Bloomberg data, no less than 13 U.S. companies sought bankruptcy protection last week, matching the peak of the global financial crisis. And just today, I saw that Chuck E. Cheese and, of course, JCPenney's is going bankrupt, a lot of other companies, you name it. So according to Bloomberg data, no less than 13 U.S. companies sought bankruptcy protection last week, matching the peak of the global financial crisis. The unemployment filings, they were led by weak consumer and energy sectors. They were the most for any week since May of 2009. Healthcare can also be blamed for a record amount of bankruptcies. The U.S. stock market really should be trading anywhere close to where its current levels are. You can see from this chart, it's an illustration of how insanely disconnected equity prices are from their underlying fundamentals. The S&P 500 profit margins estimates are plunging, and yet people are buying the dip. There's an analyst that's focusing on three major macro investing themes: a record overvalued U.S. stock market, new precious metal bull market, and a China currency bubble. The market is definitely being driven by euphoria and speculation. We'll get into that in a moment. So the Feds might be in a liquidity trap. More than likely, they're incapable of injecting enough liquidity to quell the losses in asset values associated with what was a $250 trillion in global debt at a record 3 times global GDP before the crisis even began, without also triggering a fiat money crisis. Another part of the economy that looks a little bit shaky is small cap stocks. These stocks have never been so indebted relative to EBITDA. So in terms of valuation of the Russell 2000, these stocks are now trading at a historic 15x to 2020 EBITDA estimates. And there's a stunning, totally unwarranted level of optimism still priced into the markets today. U.S. labor markets unexpectedly improved last month, but weren't enough to support the bullish narrative as of late. Everyone's talking about the economy reopening and things are going back to normal. It's just not going to happen. So a lot of indexes have already reached their all-time highs. The Russell Microcap Index is just about 10% away from its all-time high. Doesn't really matter what the index is. Separately, there's a garbage portfolio, an equal-weighted portfolio of all the listed U.S. companies with a credit default swap of more than 1,000 basis points. And yet this index outperformed the MSCI US index month to date, even after a huge retracement as U.S. markets fell sharply last week. That's the speculative excess giving these crappy little indexes a pop, with some of these prices entirely divorced from fundamentals. Hertz is a perfect example. Their stock went soaring after they had an SEC approval to issue worthless shares. It's the first time in history that anybody's ever wanted to issue worthless shares, but it's also kind of the first economic collapse with new platforms like Robinhood. There are a lot of retail traders out there, including some 10-year-olds you might see on some social platforms. This graph is showing the equity over valuation composite indicator, just kind of showing that the overall market is overvalued. But when it comes to speculation, and you've got young traders as young as 10 years old trading on platforms like Robinhood, it makes it incredibly difficult for a regular investor or institutional investor, an overall market, to kind of make sense when people are literally buying worthless stock because they just don't know what they're doing. So it's incredibly speculative, but they've been trained or taught to do this. The market always bounces back, right? Well, we're going to go into the V-shaped recovery in a moment. It doesn't always bounce back, but when you've just been kind of taught that since 2001 and 2008, and the housing and stocks and everything bounces back, why would you think different? Quantitative easing, don't fight the Fed. If they're printing trillions, don't fight them. You're going to lose every single time. You see short sellers losing billions of dollars because the Feds are going to win. But that's going to come to an end eventually. Someone's not going to buy their bonds eventually because you can only print so much money until that's worthless. But it looks like the searches on Google for Robinhood track have come to a peak. So maybe we've seen the worst of it. Robinhood has been called the Instagram for trading, and you can see an increase in brokerage accounts for Robinhood far more than traditional platforms like Charles Schwab, TD Ameritrade, E-Trade. All of those platforms are free now, following the Robinhood model of free. And if something's free, you're the product, you're being sold, and that's what's happening. Is people are paying for the information. So when you make a trade, that information is being sold milliseconds in advance to somebody else who's trading in front of you. It's called front running, but it's legal in this case because you signed up for it. You allowed it to happen. So here's some stats from online trading. 12% of all trading activity is from day traders, and yet only 1.6 are profitable. Men trade more than women, and unmarried men trade more than married men. And stock market crashes have been linked to upticks in suicide, which happened in Robinhood. Unfortunately, there was a young kid who thought that he lost maybe $700,000, $900,000. In fact, it was just a couple $100. Not understanding derivatives and the stock market can lead to bad things. If you're not broke, unfortunately, this kid is dead. So the Robinhood platform is going to tighten up its options platform after trader suicide. You know, when I was working for a stockbroker managing a $650 million fund 10 years ago, options weren't even available unless you were a sophisticated investor. So it's crazy to me that a platform like Robinhood would even offer that, because it's not generally for sophisticated investors. It's for people who just want to trade. They don't want to pay fees. They don't really know what they're doing. They're not looking at technicals or fundamentals. They're just buying dips. And I really don't think options should be even a thing that people should have on a platform like this. So don't let the new highs on NASDAQ fool you. We're still in a bear market. So the Northman trader says that the Fed balance sheet peaked during the second week of June, and so did the S&P. So to keep history alive, all highs in the fourth quarter and first quarter also came on balance sheet expansion. What that simply means is that the Feds are printing money and buying assets with it. And so that's what I'm saying. With quantitative easing, the printing of money, they're buying stuff. It's not real. When people stop buying our bonds, which then won't allow us to print new money, who's going to prop this up? Maybe those $1,200 stimulus checks help retail sales surge in May, but manufacturing is another story. The Fed's industrial production and capacity utilization puts a big negative spotlight on the emerging V-shaped recovery thesis. There was a negative revision from April, so essentially there was no rebound at all. Industrial production in May was 15% below its pre-pandemic level. Manufacturing output rose in May, but languishes near the lows of the Great Recession. The level of total industrial production was 15% lower in May than it was a year earlier, and manufacturing is at a 1988 level. So what about that V-shaped recovery? These numbers aren't even remotely close to anything that would ever be associated with the V-shaped recovery. You have retail sales versus industrial production, stimulus check one time, and those that are out of a job, it's over 20 million people. So what we're actually seeing is the greatest debt explosion of our lifetimes and probably history. Nobody's ever printed trillions. The U.S. fiscal deficit is devastated. So when the dollar is only backed by the full faith and credit, faith is waning, and credit, that's debt. So it's not backed by anything. You're not going to have bondholders for very long. So we've reached this point at the corporate debt ratio where anything above this level is going to damage growth. So the Northman trader wants to point out that this rally is really all about tech. If there's not the tech stock, then really the S&P is down negative 3.6%. New York Stock Exchange is down 13.5%. What rally? So knowing that you can't print currency indefinitely without consequences, you've got to ask the question right now, is gold signaling that stocks are now on shaky footing? There's a really good ratio to look at, which is the S&P 500 versus GLD. That's a gold ETF, which is a proxy for the S&P 500 priced in gold. So although equities bottomed in nominal terms back in the early 2009, the post-financial crisis for low equities in gold terms didn't occur until the second half of 2011. From there, stocks in real terms soared for 7 years in an extraordinary and historic bull market. But then in September of 2018, something changed. So equity suddenly stopped outperforming gold, with the ratio topping out at just under 2.6. Gold even outperformed the tech-heavy NASDAQ since then, even though not by nearly as much. So through 2019, he paid close attention to the SPY GLD ratio. It fell to around 1.95, which was important. So this level would represent some sort of watershed moment. So the Liberty Blitz, they have a chart showing the stock market priced in gold, and when it breaks 1.9 and stays below, you know the world has truly changed. So we're testing that level again today. This could be an indicator of an early stage of a monster bull market for precious metals that'll get going on in 2020 and last several years. So overprinting could create a banking collapse, and that banking collapse would be a game changer for the financial markets. And some should be worried that the Fed has been bound by the dollar's future to their fortunes. So the performance of the S&P 500 since March 23rd has been unhinged from any business conditions, giving a little bit of a clue that there's a flood of money emanating from the Fed, fueling stock prices. It's also fueling prices of all other financial assets. There's a lot more reporting that the era of the US dollar's exorbitant privilege as the world's primary reserve currency is coming to an end. So if you've noticed that the US fiat currency is slowly losing market share as the world's reserve currency, you might want to think about investing in gold, which could help offset that trend. The accumulation of gold as a reserve asset historically has seen a responsible policy response in periods of crisis, may very well become a policy option of choice in the future. Central banks around the world, including the Fed, hold almost 35,000 tons of gold reserves. If you are interested in investing in gold, it looks like there's a potential cup and handle pattern. So the slow and steady pattern in gold prices over the last 4 years is seeing gold recover a majority of its losses post-2011 highs. It's also helped to form a potentially bullish price pattern, the cup and handle pattern. So this spring, we saw that the cup was in formation and now appears to be nearly complete. So this type of breakout action from this pattern could see gold target the $3,000 price level. And if history is any indicator, it'll tell you to get gold when central banks are running out of control. The U.S. has all the ingredients that led to the destruction of an empire. You have deficits, debts, excessive military spending, debasement of the currency, breakdown of trade. But ultimately, 1971 marked the beginning of the end for the U.S. empire. That's when the U.S. decoupled from gold. So U.S. debt is now at $26 trillion, likely to reach $28 trillion by the end of the year, $40 trillion by 2025. So since 1974, the U.S. has had a balance of trade deficits every year. So you can't have a half a century every year importing more than you export. It's only possible with the assistance of a printing press combined with constant credit expansion. So owning gold is as much about diversification as it is about capital appreciation. Gold actually has a closer relationship with the quantity of money in the economy than it does with actual inflation. Since 1971, the US dollar and all major fiat currencies have fallen between 97 and 99% in real terms. Real terms meaning measured in gold, which is the only stable currency in history. So invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.